Got Ravi Hedge joining in on the show right now. Ravi, hi, good morning. Thanks for making time. What is it that you're making of this interim order by Sebi? And we were just anticipating that, perhaps Jane Street is also going to challenge that.
Yes, this is an interim order which has been passed based on their prima facie understanding of what the facts are. And in fact, rising up the indexes because of trading excessively in stocks and futures is not new to SEBI. In fact, if you remember earlier, the earlier chairman of SEBI had passed a similar order in the matter of Infosys, where they had identified that there is a strong correlation between derivatives and the underlying stocks. Now, this order, strangely, while they say that they are impounding such a huge crore, they say if you make this payment with SEBI, the trading restrictions will be vacated. Now, just imagine the index, how this was moved. And they have identified only some during the investigation period. We don't know how best, the investigation will succeed as to what are the other trades or on which other days they have traded this. So right now, there is no question of challenge because this is an ex parte order and a hearing is afforded to them. But this is really absurd that trading in such high volumes. I don't know whether SEBI will take the assistance of other regulators abroad to understand as to what is the correlation, because enforcement of this order now becomes a challenge. Nobody knows whether that money is still with them or whether it has been deployed in other trades. That is still a gray area at this stage, is what I feel.
Now, can you just break it for our viewers that what possibly Jane Street has done, which in a sense has come in the eye of the storm of the regulator, and what SEBI is essentially trying to plug here?
Sir, essentially, if you trade aggressively in either the stocks or the futures, per se, it's not a violation. But what SEBI understood is, in patch one, people were trading excessively, like in taking trading positions where they were aggressively buying in a Nifty, where of course they did not find anything lucrative. On the very second day, in the second patch, they used to square it off. That makes no essential or any economic sense because they were incurring losses. What SEBI then analyzed is the underlying indexes moved up. And they used to trade taking the position closer to the expiry where they could actually learn their leverage over this. Now, a common investor will not know what is the real reason why the indexes are shooting up. So, in short, they took advantage of the correlation between the derivatives and the stocks, manipulated the stocks and futures in such a manner that they were the excessive trader. They reversed their whole position and the index was up. So, they traded at a favorable price. That is basically what has happened.
I understand
I
that.
just explained in a nutshell.
I understand that, Ravi. But in terms of a law and in terms of the regulation, is this something which is illegal?
Yes, absolutely. Absolutely. See, SEBI has, we have prevention of fraudulent and unfair trade practice. Anything in relation to purchase, sale, or issuance of security, if there is any fraud intended, which has a capacity to induce a common investor to trade, that amounts to a fraud. So, therefore, Regulation 3 and 4 of FATP regulations has been levied. Now, even under the FPI, the nature of the trades, the manner in which the FPI are required to trade, they have also been flouted. Now, any common investors, if you see, there is an underlying aggressive position which is already taken, which an investor would not know. The investor thinks that, okay, there is something going up, let me trade. Now, this inducement is because of a fraudulent activity. It is why FUTP regulations are triggered. Now, interestingly, while SEBI still says that there was a caution letter issued by NSE, the period is only from January 2023 to March 2025. We do not know as to what else would come up because the investigation is still pending. And SEBI in its wisest wisdom will understand if there is any other correlation as well, whether any other entities are involved, whether brokers are involved in per se synchronization of trades or reversal of trade. There are larger issues to be looked into. Now they have identified only these 5% because they saw concentration of trading between these entities. Over a period of time, we will come to know whether there are any other entities also associated with this. That is the larger position. It is per se a fraud. The definition is very clear.
Sense. 4 entities, the total profit equating to about 36,500 crore rupees. And I was just going through the breakup of these entities and the kind of profits they actually made. There's Jane Street Asia Trading, 6,900 odd crore rupees. JS12 Investments Private Limited, 168 crore rupee profit. JSI Investment Private Limited, 4,104 crore rupees. And Jane Street Singapore Private Limited, which made a profit of about 25,636 crore rupees trading in India equities. But good to have you on the show. Thanks for analyzing, Ravi, what exactly this interim order means and what could be the next steps in process. But let's now try and analyze